Today we'll talk about the investor type and how we are interacting with investors types and how we're making sure to target the highest qualified investor to engage with and to interact with. That's what I can promise you. In the end of this video, you will understand something new that will help you to rise up capital with your own investment firm, with your own startup, or with your own hedge fund. Let's get into it directly. So what we are doing in Mina Growth, we are raising capital. We are a global fundraising firm. We have been in over 10 markets so far, and we are raising capital for hedge funds, for investment firms, and for private banks and startups that make sense to invest into. First of all, we're taking a look on non-accredited retail. Let's take a look on all of the types: non-accredited retail, accredited retail, angels, venture capital, private equity, family offices, funds, channels that we are reaching out to them if we want to. So for non-accredited retail, LinkedIn outreach ads. Accredited retail, we're using LinkedIn outreach ads. Angel, we're using direct outreach email. For venture capital, we are using direct email, which is direct outreach, direct one-on-one. Private equity, direct outreach email. Family offices, direct outreach email. Funds, direct outreach email. So keep it in the mind, only the accredited retail and non-accredited retail, you will reach out to them for ads. All the other types that you're looking to reach out to get found from, you can reach out to them directly through direct email. All right. So you can reach out to them through LinkedIn or outreach or ads. So stage, let's take a look on what we are talking about right here. Early to late varies weirdly. So here, which stage that they are investing into depends on, but early to late, which are the non-accredited retail, all right? Right here, accredited retail, what they are investing into. So the company or the startup that they are investing into or the fund, which stage are they are investing into? Early to mid stage, all right? Angel investors, seed to early stage. Venture capital, early to growth stage. Private equity, later stage. Mature companies, family office, flexible from early mature companies. Funds, typically later stage, pre-EBO or public companies. So funds, they're coming in the last uh, stage before you're going to the public. The early stage, let's take a look on the early stage. Non-accredited retail, equity crowdfunding, convertible notes, accredited retail, direct investments, syndicates, angel investors, equity, convertible debts, venture capital equity, sometimes debts, private equity buyouts, securitization, family office equity, real estate, various alternative assets, and funds, public equities, sometimes private placements. Valuation. Let's take a look on which type of valuations they are investing into for each one of them. So non-accredited retail, lower valuation for early stage investment generally. Accredited retail, sensitive to valuation, looking for reasonable entry points. Angel investors, sensitive, looking for value and growth potential. Venture capital, market driven, but looking for high growth potential. Private equity, willing to buy for established businesses with stable cash flow. Family offices, looking for reasonable valuation with wealth preservation and in mind. And funds, they're looking at market assets, often looking for undervalued companies. All right. I hope it was clear. I hope you gained something so far. And let's take a look. Capital raised. Less concerns are the non-accredited retail. Accredited retail, moderate amounts, right? Moderate amounts. So that's the difference between the accredited and non-accredited. Accredited, moderate amounts. Non-accredited, less concerns. Angel, often the first outside investors. Venture capital prefer companies that have shown some traction. So venture capital, they will not invest into you if you don't have any traction. So that's absolutely obvious. Private equity interested in companies with significant revenue. Family office can vary widely, so it depends on a family office. If you can build a good relationship with them, so you absolutely they will invest into you early stage. Funds prefer established companies with significant capital raise. Now let's take a look on team, track record, etc. So non-accredited retails, less embassies, but credible leadership is a plus. Accredited retail, more embassies on a strong team with some track record. Angel investor highly focused on team potential and vision, which are capital, critical, looking for experienced and successful teams. Private equity expect a strong management team in place. Family office interested in strong teams but may also consider family connections. Funds, let's take a look. Funds expects professional experienced management team, which is obvious. Now let's take a look on the product, market fit, etc. So non-accredited retail, not always necessary. Many invest in ideas or portfolio type. That's what they are doing. Sometimes they just invest into you. Accredited investors prefer some evidence of market fit. Angel investors are not necessary, but should have a clear path to it. Here we have venture capital, essential with some traction and customer validation. Private equity must be well established. Family office prefer established products, but may take earlier stage risks. Funds must be well established with significant market market share. All right. So let's get into the next one. So vertical industry. So I think if you only understand what I have already presented to you so far, you will do fine and you will understand something new that will help you to rise up to yourself. That's the same exact strategy that we are using to raise capital for our clients. That's exactly what we are taking a look on, and that's exactly how we segment and how we making sure that we will only get upfront the most qualified type of investors, funds, family offices, private equity, angel investors, accredited investors, non-accredited investors. So that's how we are doing that. So now let's take a look on the vertical and the industry. Non-accredited retail, broad interest, so they may invest into several industries. Accredited retail may have specific interest or expertise. Angel, pick certain sectors. Venture capital mandate focused. Private equity broad but often focus on industries with stable cash flows. Family office often have specific interests aligned aligned with family wealth origins. Once diversify it, they may invest into several industries at the same time. It depends on which one that has shown the highest growth rates. Like right now, AI, everyone going into AI right now. So AI is a good place actually to work on and to do something with because they will invest in not only funds but even venture capital. Venture capital now they are into the AI industry and they are investing the most of their own investments into it. So if you are into it, so there is a huge opportunity right there for you. And if you can enter authentic and do something with AI, so you will absolutely have a huge advantage. Now let's take a look on market sentiments. Non-credit retail influenced by trends and both credit retail consider market trends to look of fundamentals. Angel investors often invest based on personal conviction over market sentiments. Venture capital analytical approach through can be influenced by trends in VC. Private equity less influenced by sentiments, more by financials. Family offers can be of long-term value. Funds driven by detailed financial analysis through market trends can play a role. Now let's take a look on the last one, exit strategy ABO properly. So a non-accredited retail not always a primary concerns, longer term investments, liquidity retail interested in clear exit strategies, angel investors long term view but want a defined exit strategy, venture capital essential typically looking for 5, 10 years exit, looking for 100x all the time, private equity interested in clear profitable exit strategies, family office flexible often with a longer term investment horizon. Funds looking for liquidity events, less concerned with EVO specifics. So that was everything that you need to understand, and you need actually to have in your own mind in order to understand how you can break down the investor type matrix, and that's what you need to understand before you rise up capital. And even if you are rising capital today, you need to understand all what I have already presented to you right here in order to understand how you can reach out to them and how you can communicate with them, build your own intro deck on that, and how you can grab their own interest and grab their own attention. Go to rise up capital easy. Guys, that was everything for today's video. If you would like to rise up capital, you can take a look on the description below. I have something for you right there. And if you have already received any value of today's video, you have learned any something new, you can subscribe to this channel if you would like. And until then, have a nice day.